This is Jody Trana with Chapter 8 of Business Finance. Andrew Carnegie is a famous American industrialist. He amassed a fortune in the steel industry, and then he became a major philanthropist. He is most famous probably for his free public libraries that he built throughout America. He built 1,700 libraries in the United States. We have one of his libraries on our campus. It's the Carnegie Building over on the corner of Prescott and 48th Street. If we could translate his fortunes to modern day money, he would be worth $14 billion today. Here's his philosophy of investing. The way to become rich is to put all your eggs in one basket and then watch that basket. And that is indeed what he did in the steel industry. Now let's turn to a modern-day mogul, Warren Buffett, the Oracle of Omaha. Warren Buffett, he was born in 1930, so that was almost 10 years after Carnegie passed away. People call him America's most brilliant investor. Year after year, he makes record returns on his investments. Warren Buffett is worth about $80 billion. And what's more remarkable than that is how much money he gives away. Every year he gives away billions of dollars in an attempt to share his wealth. His view of investing is do not put all your eggs in one basket. Today we're going to talk about a couple of different kinds of risk and how we can avoid risk in our portfolios. So to understand how an investment contributes to the risk of the portfolio, we categorize the risks of the individual investments into two categories, either systematic or unsystematic risk. The systematic risk measures the contribution of the investment to the risk of the market portfolio. For example, a war or a recession. There are things that happen that are unavoidable, and we really can't do any kind of diversification to mitigate this risk. There's also unsystematic risk, which is avoidable or at least diversifiable. There's also unsystematic risk, which is avoidable or at least diversifiable. GoPro gives us an example of an investment that has some risk associated with it. So GoPro, the company, it debuted at $24 a share back in 2014. The shares jumped 31% immediately, and then it peaked at $98. But just 4 years later, GoPro stock was trading at $5.50. Now, you can't always avoid this kind of risk, but you can diversify and spread that risk across your portfolio. As we learned in the previous chapter, one of the ways to identify risk or to measure risk is to calculate a standard deviation on an investment. Here you can see a list of investment types, their compound annual return, and the standard deviation. This is solely for our discussion purposes and is not an accurate view of compound annual returns or standard deviations for these investment types. But if these were true, can you identify the investment type with the lowest risk? U.S. Treasury bills is on our list with only 1.5% standard deviation. How about the investment with the highest risk? That would be emerging market stocks with 28.7%. The higher the deviation, the higher the risk. Sometimes investors are comfortable diversifying just by buying stocks from different companies. But we need to be careful that diversification is a full diversification and not just separate companies. Let's take these two companies, for example. Let's say that we invested in a company that makes sunglasses, and we also invested in a company that makes suntan lotion. Both of these investments may have correlating responses to the market. If we wanted to invest in a sunglass company, we also might want to invest in an umbrella company. That way, when it's sunny, at least one of our companies is going to do well.
Angela and Tony are watching a bicycle race between 10 riders, and they decide to make a friendly bet. Tony thinks that the Italian Giuseppe Rosso will win the race. Angela disagrees, but is not sure which of the other riders will win. She likes 3 of them: Robert Brown from Britain, Otto Gelb from Germany, and Pierre Violet from France. Tony suggests the following bet. If Giuseppe Rosso wins, then Angela will pay Tony $100. If any of the 3 riders that Angela likes win, then Tony will pay Angela $30. Angela agrees. The bet seems somewhat lopsided, however, as Tony can potentially win $100, but Angela can only win $30. The reason for the difference is that Angela has a diversified risk, while Tony has a concentrated risk. Angela has 3 chances out of 10 to win, while Tony only has 1 chance in 10 to win. Angela has a higher chance of winning a smaller amount compared to Tony's lower chance of winning a higher amount, so the bet is fair. Angela and Tony's different approaches to risk are also shown in their investment portfolios. Tony has invested all of his money in one high-risk chicken farming company, hoping to get rich quickly when the company's business takes off, while Angela has carefully divided her money across a broad range of shares, bonds, and property investments. Tony will undoubtedly make much more money than Angela if the chicken farming company performs well, but he could also lose everything if the company goes bust. Angela may make less money than Tony, but she also has less risk of losing all of her money. In her portfolio, the different asset classes are likely to perform in different ways at any given point in time. When one investment does well and another does poorly, then the 2 performances may cancel each other out, leaving her portfolio with neither a loss nor a profit. This can protect her from poor performances by particular investments that she chooses. Overall, Angela will hope that she will have more positive performances in the portfolio than negative ones, so that overall she will make a modest positive return on her portfolio. In summary, the process of investing money across a wide variety of different investments is called diversification. Diversification is an important investment strategy that can reduce risk in a portfolio by making the portfolio less likely to suffer large losses in negative scenarios.
The philosophy of creating a well-diversified portfolio is really only part of our conversation in this chapter. We also need to be able to calculate an expected rate of return for a portfolio with different weights based on different returns. Let's take a look at Penny's portfolio and the expected rate of return for all 3 of her investments. She has half of her money in T-bills, a quarter in Starbucks stock, and the remainder in Emerson Electric stock. We start by multiplying each percentage return by the weight. So for Treasury bills, we have 4% times the weight of 0.5, which is 50%, and we get 2%. For the EMR stock, we have 8% times 0.25, which is 2%. And for the Starbucks, it's 12% return with a weight of 25%. That gives us 3%. Penny's portfolio is expected to bring her 7% in returns. That's quite a bit lower than the Starbucks stock. Why wouldn't she just invest all of her money in the Starbucks stock? because of risk.